AI and the digitalization of financial services is reconfiguring the way financial institutions operate, bringing a variety of benefits as well as new challenges. Our next panel will take a closer look at how to navigate the increasingly complex intersection of technology and finance. Let's welcome our moderator, Julia Leung, from the Securities and Futures Commission, and our panelists, Mike Gitlin from Capital Group, Jenny Johnson from Franklin Templeton, Danielle Pinto from JPMorganChase, Peng Zhao from Citadel Securities. Julia, thank you.
Thank you. So I finally got your attention. Now I'm glad to lead this discussion on two of the most exciting topics to shape the future of finance. Now, as we all know, technology is not new. It has been a driving force for changes, the way that portfolios are being constructed, the way that deals are being made, creating new opportunities in enhancing efficiency and customer experience. But recently, the pace seems to be picking up with generative AI and digitalization, which seems to have immense potential to further accelerate that change. However, with these, they also come with risk. And new risks have arisen, and there's even talk of existential threat to human. So we must ensure that technologies are being responsibly adopted and safely adopted. And that's, for many firms, it could be cash burning as well. So today I'm very pleased to be joined by four very prestigious panelists to shed light on how technologies are changing and reshaping the financial services industry. Now, speakers on these panels have a tendency to market their services. I would do the same for our circulars and our regulatory framework. Now, just last week, the SFC has provided guidance to the industry about the deployment of generative AI large language models. While we encourage licensed firms to be using that technology to innovate, to raise productivity, but at the same time, generative AI amplify existing risks, and we should be more cautious about. So what we are calling on a licensed firm is to take a risk-based approach in your deployment and in areas covering senior management responsibility, AI model risk, cybersecurity, data, and third-party vendors to be a little bit, pay a lot more attention. For digitalization trend, Bitcoin may be surging past 90,000 US, but and where it is heading is not our concern in this forum. We will be looking at the bigger picture of digitalization and tokenization of assets, from bonds to money market funds, and how the financial markets can benefit from it. SFC and the HKMA are working closely together to scale up the tokenization markets and expand the use cases. And for that to happen, there's a need for an enabling and interoperable blockchain foundation layer and a coherent rulebook on blockchain-based financial services. And this is what the HKMA's Assemble sandbox is doing, and there are recent fruits coming out of that sandbox, like tokenization of money market funds by local bank using tokenized deposits. So in this process, we try to identify issues, particularly regulatory hurdles, and provide clear guidance. And we do expect that it's only with clear guidance from regulators can we see the convergence of DeFi and TradFi, with the latter providing the much needed trust and compliance in the Web3 space. So let me kick off by taking the first topic on AI. And to start off, I would ask each of you a question to rate your firm's use of AI from 1 to 10, with 10 being the highest. Now, this is not a competition, so you don't, because you are in totally different areas. Just describe the areas of application, but more importantly, to see where your firm is 3 years from now in the use of AI. I'll start with Mike.
All right, I wish 35 years ago at university they asked us to give our own grades. I would have done a lot better. Look, I think it's impossible to give a numerical rating on something where you don't know where the finish line is. And the finish line, when you do think you know where it is, will continue to move. The way I think about it from a capital group perspective is we use technology for 3 reasons, right? 1 is to make our business more efficient. 2 is to service our clients better. And 3 is to generate better investment results. On the first one, and we just use real examples, on the first one, I sent out a message to our 9,000 associates called 30-30-30. And it was, please reduce the number of meetings by 30%, reduce the number of people in the meetings by 30%, and reduce the gold-plated PowerPoint presentations by 30% so we can be more effective. So how do we do that? In our Teams system, you can be late to a meeting and hit a button that says, catch me up, and it catches you up. Or you can entirely miss the meeting and let the other 10 folks carry on and get a summary and action items for yourself on what you needed to do coming out of the meeting. If we save 30 minutes for every associate a week, we would save 14 million minutes a year just by being willing to miss 1 meeting once a week for 30 minutes. So you see the scale you get from something like that. In a client-facing role, we use PrepMe. And PrepMe means as you go out to spend time with clients, what are the 20 or 22 inputs about the client that would make the meeting more effective for them, not you? And that technology is very helpful. And then in the last one for our investment group, we have something called Blue Team, Red Team. Assume we are large owners of Netflix, just as an example. Much greater than any benchmark, much greater than competitors. The other, what we use technology for is to create the bear case. So we don't live in our own echo chamber. And then one of the analysts takes that AI-generated bear case and conducts a debate with the folks who are the largest holders just to challenge our assumptions. So just trying to bring those examples to life on how we use it.
Okay, you refuse to grade yourself. So Jenny.
Well, because Jenny will have a higher grade, so I knew she was going second.
No, because actually I agree with your point, which is, what's the scale? Like, I'm pretty sure everybody here has been using machine learning in their, company for a decade. So if you want to measure that, we'd all rate it really high. So I asked, our Franklin Equity Group is housed in Silicon Valley, and the CIO is an engineer and with a tech background, and he's the one driving it so much through the firm. He literally, in a meeting, grabbed from the tech guy to show the other investment people what you can do with Quarter Pro and Perplexity and some other tools. And he rates it a 3. And I was thinking about that, and I thought, he's focused on it all the time and pushing his team to be thinking about the efficiencies that they can, not cost efficiencies, but time and information efficiencies. And I was thinking, you know what, if I come back next year and you ask the same question, we will have done a whole bunch of stuff, and I'd probably say it's a 3. Because the problem is that we're just starting to open up what the opportunities are and how we're thinking about all of us as an industry. If you look at technology innovation, the first thing that people do is they just make more efficient and improve the things they do today. Because they can't yet envision what the technology ultimately will do on the disruption side. And you have to get your teams comfortable with using the technology before you'll actually get to see what those true disruptions are. So I think that wave hasn't really hit us yet. And then I was thinking about the operational areas, and we have some great stories, great examples of where we find efficiencies. But then I started to think about all the service providers in this room and how they're going to have all these efficiencies, and what do I need to do in my contracting to make sure that those appreciate. Daniel, over to you.
Thank you. So AI has been a 10-year journey. So traditional AI. And on that, we have many, many use cases on automating reconciliations, credit decisionings, embedded in trading algorithms, fraud and fraud detection and fraud avoidance. So that is being, and from research to center of excellence to embedding it in each of the lines of business, that has happened and it will continue happen. So instead of giving you a rating, I will give you numbers, real numbers of JPMorgan. So we do measure the impact of all this. And the impact for last year was around $1.3 billion, either cost avoidance or increase in revenues. And this year will be around $2 billion, a big increase. And $2 billion is a lot of money, but the top line of JPMorgan is $170+ billion. So you can argue that all that we have done is increase productivity, but a bit over 1%. But I think that we are at the very, very beginning, and the confluence of traditional AI and large language models, they are going to really change and going to be a big, big productivity gain. And I'll give you one example. 2 years ago, we asked one of our PhD experts in artificial intelligence to look at one of the operational processes, that is know your clients, KYC. In 2 years, by automating, going through processes, applying automation through AI, and we haven't yet touched large language models, the cost of processing a file has gone down by half. And I think that in the next 2 years, it will go down by another 2.5. So going forward, so large language models that we are at the very, very beginning, I see 3 phases. First, you give the people the model that comes out of the box, and you will have some marginal productivity. Then you move into really knowledge experts, where you complement the models with the knowledge of the company, and then you can do calculations, you can do data inquiries, more related to the company and things like that. It will be some more improvement in productivity. And the third will be agents that we're really going to see the big improvement in productivity. So in the next 3 to 5 years, for me, the biggest impact will be towards productivity, a lot of more of top line growth. And that will be in operations. That is like 50, 60,000 people across JP Morgan. Efficiencies in data, in global call centers, and technology developments. I can see in all these 3 a massive improvement in productivity as we continue deploying, reviewing processes, continue to deploy AI, and deploying large language models in percentages that it could be very, very substantial.
Thank you. Peng?
First of all, thank you for having us here. Fall in Hong Kong is one of my favorite times, and there's always excuse to come back to Hong Kong this time of the year because this wonderful event you'll organize. So I look at the question a little differently. I think from our vantage point, one of the critical things that we focus on is in which areas we want to work and strive to be a 10, and in which areas we want to work and strive it to be a 0. So knowing which areas we expect the highest amount of return from the investment in AI and automation in general, and which areas it likely turn into a giant science experiment, a waste of resources, has been the key focus for me, myself, and my leadership team. Certainly in some areas where it involves gathering a large amount of data, information retrieval, AI and large language models have brought in a higher quality level of processing power that we've been seeing in the last few years, and there's a real acceleration here. Keep in mind that we have about 1,600 people, but we transact somewhere around $500 billion of daily transaction across more than 50 countries. So anything that happens anywhere in the world, and it could be in languages no one at the firm speaks, if it moves the market, if it moves the instruments that we need to transact in, we have a desire to know that. So a lot of these technological breakthroughs in natural language processing, large language models have increasingly allowed us to retrieve data, process it, model it, and understand it on an increasingly automated basis as well. So the approach we've been taking is really look into what are our most important workflows, and how do we get better at that, how do we get more productive and efficient at that, or the most pervasive workflows. For example, we often joke that the most commonly spoken language at our company is C++. So getting our developers to write code more efficiently would be one of the most common workflow we have around the firm. But we try to not get stuck in between. If we don't pick an area as an area of focus where we're going to deploy, we try to not touch it at all. So very top down, lay out different areas and figure out where we want to get to a 0, and where we want to get to a 10. So I don't know how you weigh the zeros and tens and get up to an average number, but so far I think we've been doing a pretty good job.
So it's either 0 or 10. So which area we get a 10?
Again, in areas of our core competency, retrieving data, processing data, making sense of it, to figure out how to get to a good price and quickly and efficient way, how to facilitate these transactions in the most seamless, error-free fashion, we will always strive towards a 10. And by the way, a lot of times that just takes good old-fashioned automation. It doesn't always involve Gen AI, large language models, or at all. Those are tools at our disposal, but just because we can use those tools doesn't make them the best tools possible. Yeah.
This is a very good excuse to look at every process in the company and start at the basis, even forgetting about the AI, just looking at the process and making it efficient, and then automate on top.
Mike, it sounds like our service contracts with JP Morgan to get cheaper.
I think you're right. Thank you, Daniel.
Now, I've noticed that it's never a simple question. Only Jennifer answer it, like from 3 to 6. The men in the room have a different, very thoughtful responses. Now, I would dive a little bit deeper into what Peng said about the use of generative AI in trading. You've actually laid it out quite well. We've always known that traditional tools work very well in terms of like reducing spreads and enhancing and giving you the data and analytics. But with the use of that traditional technology, we already see a huge increase in trading volume, liquidity, but also volatility. Now, if generative AI is going to do a better job, a quicker job, so are there any concerns that it will exacerbate the trend of herding behavior, which Gary Gensler talked about? Any concentration risk, particularly when the AI model are provided by a few providers right now, and whether they are very similar, driving to very similar trading decisions, and how do you mitigate those risks?
Well, thank you for that question. I actually forgot. I should thank Howard for giving us the shout out on the last panel. It was quite a surprise. But I mean, look, when we started over a little more than 20 years ago, if you look at how a typical investor would transact in the United States, if they want to buy or sell stocks, you need a minimum deposit of $10,000. You got to call your broker every time you want to trade. To make a trade of a few $1,000s, you got to pay $100 in commission, right? And on top of that, if the day after election and you want to rebalance your portfolio, so does everyone else, you may have to stay online and wait for your turn, and you may need to wait for a long time before you get connected and call back again. Today, you need a smartphone. You need $100, sometimes not even. And you have a transaction cost that's lower than most institutions without commission. And all that happened because the tremendous amount of efficiency automation have created. The entire workflow from the moment an order is placed to a moment that order is executed has been automated to such a degree, the cost of executing that and facilitate that went from $100 plus to almost nothing. Right? That is a possibility of what technology has enabled. And you look at US household, something like 62% of US household own a stock, either directly or through a fund. Right? That number is about 20% for Japan. That number is less than 10% for China. So that really powers the economic development and growth and prosperity of the United States. And so much of that could not have happened without the power of technology, analytics, and automation. Now, there is the concern that some people are asking out loud, which comes in the following form. Can the product be so good that people like it so much, people use it too much, right? I've never seen the solution to that sort of concern to be, let's make the product worse so that the clients or consumers would use it less. That's never been a successful solution in anything I've seen. Or the question could be asked in the following form, that is, hey, people didn't quite have transparency. They didn't know what was happening to the stocks they were following or had an interest in. Now they have unparalleled amount of transparency, and the amount of information you can get just by logging onto your app is dwarfs where a traditional or a professional trader had access to 10, 20 years ago. So you all of a sudden could ask the question, could there be herding? If all of a sudden everyone have access to the same information, whether you're a professional trader that got paid $500,000, $1 million a year, or someone who only have $100 in your broker account. The answer is, it's not bad to have everyone to have information. In fact, that's a huge step forward. Transparency is good. But there could be a step too far if we take away the individual's need to make their well-educated, well-informed decision, and we start making decisions for them. Right? That is the fear of what generative AI may do, and then all of a sudden we'll just tell everyone what stock they should be buying and selling. I think we're pretty far from that. I think a lot of the people in this room run some of the largest brokers and wealth management firms for their clients. I don't think any one of them will tell you, hey, they're ready to have their AI agent to tell their client what stocks to buy or sell without real advice and input. I think we're pretty far from that.
Very good intro into what I'm going to ask Dan about guardrails and risks and whether we're too much reliant on generative AI when we are going down that journey.
So clearly at the moment, no, because we are at the very, very beginning of it. But when you think about the control environment that you need to have around generative AI is by far more complex than what we did for traditional artificial intelligence, where we learn how to analyze the models, we can explain how the model works. We have done a very good job, most of the companies, in managing data and data accuracy and data privacy. So all done for traditional AI. I feel that most of the companies are in a good place. So when you go into large language models, so it all gets a bit more complex because these models first you may not have access to the model itself because it's provided by someone else. But even if you were to have it, so it has either millions or billions of parameters. So the way that you have to explain the model is more to the output of the model rather than by the functioning of the model. So these models are still, though they are progressing very fast, they still hallucinate. So there are errors in the models that probably the partnership between us that we are using the models and the one that are generating the models will have to work to improve that situation and reduce that risk and have models that they are going to control the models or check the models, and we are working in that too. And data is another issue. So we are in a good place, but it's still a long way to go in order to make sure that the usage of data that is going to grow so much is to a quality that respects data privacy, that we don't violate any of the rules there. So when you are using it in quantities by far bigger than we ever did. And then one simple thing also is to train the people. So we deploy large language models off the box to 220,000 people. So now we are training to do the basic things. So these are not the second phase. It's like the first phase of model. So we need to train the people in order for them to be aware of the good things that come out of the models and not the so good things that come of the models. And the last one is the work that we have to do with the Microsoft of this world, so all the others, to make sure that we reduce the risk of unforeseen events going forward. And just one more comment on regulations. I think that hopefully all these companies, they are very, very highly regulated. So there is no need to regulate AI because AI should do what the regulation tells us to do today. So it's about to controlling the risk, and hopefully the regulation goes that way rather than trying to control things that they already massively control and regulated.
Your point taken. We are not regulating the activity, not regulating the AI itself, certainly, but certainly have to look at the risks that generate out of it. And one of the risks is hallucination risk. I'm going to ask Jenny to a live example, because you are also announced a partnership with Microsoft to build an advanced financial AI platform to improve the productivity of sales and also personalized client experience. Now, as we know, there is a question with the majority of fund manager using the same providers to produce investment decisions. How are you comfortable and how are you going to generate alpha? But also the question I asked about mitigation of hallucination risk. Daniel's already talking about, now machine learning is less of a black box because it's more predictive and you have a formula and algo. But then with generative AI, you are actually even black box. And so how comfortable are you without any human in the loop and providing that investment advice to your clients?
There's a lot in that. So let me first just talk about the Microsoft partnership. So we approached Microsoft with a very simple problem that has a very difficult technical solution. And they were excited about, because most people are approaching AI with a simple proof of concept on, let me reconcile, we do it too, let me reconcile this data, let me generate this RFP. This is more of a platform. And so the simple problem is, how do you optimize the conversation, say, a salesperson has when they go visit a financial advisor? And so you need the AI to go in and look through your CRM system to get whatever information you have there. You're going to want to understand the holdings. You're needing to go to external third-party data to compare kind of performance. You're going to want to look at your own performance data that's going to be able to figure out which is the most optimal opportunity to pitch to the advisor. You're going to go look at social media, and you're going to figure out, what kind of personal connections can I make. Each of those things requires a different AI algorithm. That's the technical problem, right? So it's that integration. And, I would say large language models are like the kid who gets an A in English and an F in math. You have to marry them and integrate them with very specific algorithms that can calculate things. And each of those end up being very specific. And the skill set of the programmer to build those models is different. And so Microsoft actually liked the idea behind it and are supplying us with quite a few resources to build it because they want to get the domain knowledge to understand how they can ultimately go to other firms and say, hey, we can help you do this, right? We're doing the same thing on the investment side, and it will be Microsoft or somebody else, where from an investment person, think about, you have an idea and you want to, let's say you were covering transportation, that was your sector, and you're wondering what, the global positioning system technology might disrupt, right? Think about how much it did ultimately disrupt with Uber and other types of car servicing or shared car services. So you'd ask the question with kind of a ChatGPT interface. It would go through all your analyst reports. It's going to go through the street reports. It's going to look through what kind of people have been talking about it, just massively evaluating information, bringing it back. And then the key is, on that's dealing with hallucinations, is you have to have a human who's evaluating it and able to prompt the right questions, right? And so that's where the skill set and having kind of the curiosity is going to be really important in employees to be able to iterate, and that's where you ultimately get your alpha, right? It's just about being able to consume a whole bunch more information in a way that you can consume it quickly, and ultimately still the human is making an investment decision.
So there will be a human going through this before you hand over
At
the
Franklin
information.
Templeton, there will be.
Yes, all right. So Mike, you're one of the largest active manager, and is known for your research and fundamental research and analysis. So how are you going to marry this AI thing with your portfolio team and the research team?
It's interesting. If you dial back 25 years ago and you think about .com, make up a fake company, a cement company called World Cement Company. If they would have changed their name in 1999 to cement.com, the stock would have gone up $50. And so when our folks are looking at AI, you have to be really careful in not indexing AI, because that's really hard to do and it's dangerous. So any company you own that changes their name to something AI, you should sell it. The other thing I would say is you think about it in different levels. The participants in AI, everyone's seen that 4 stack or the 4 rungs on the ladder. And if you think of semiconductors and infrastructure and models and applications, one thing you'll notice on the 2nd, 3rd, and 4th rung of that ladder is there's some companies in common. Microsoft, Amazon, and Google or Alphabet are all in common in the 2nd, 3rd, and 4th rungs of that ladder. So I think that's something to be mindful of. You also look at the other impacts. People are talking about AI, but they're not talking a lot about AI robotics. Waymo from Google is basically a 4-wheeled robot. It's self-driving in 4 cities. They're doing 150,000 pay rides a week. They'll be at annualizing at 8 million, and they're just scratching the surface. Who in this room doesn't think in our lifetime you won't see self-driving cars gain a big market share in the marketplace? I think we all know it's coming. If self-driving cars were 10% of the miles traveled in the world, that would be a $150 billion profit pool. Our analyst looks at something like Google and sees Waymo not even impacted in the price in Google today. And you think about that kind of optionality over the long term. And Amazon with Sparrow picking 100 million items in 7 seconds with a low fail rate, drone delivery, these are all super exciting. The last part I would say is utilities. I was in New York last week and I saw our credit analyst who looks at utilities, and he said, I never thought I'd be a tech analyst. And I never thought I'd be in a growth sector. And utilities, you have to do both right now. And it changes a lot of things. So, John was talking about data centers. Regardless of anybody's math, everyone's pretty darn sure data centers will be more than double its current share of energy consumption in the US in the next few years. So these are going to be really important. What do data centers need? Cooling. Who's doing the cooling? It needs 1 million tons of copper. That changes your commodity outlook. So all of these things are really important when you're trying to do bottoms-up research and figure out who are going to be the winners and losers.
All right, so let's move to digitalization, digital assets and technology. Now, BCG estimates that the market size of tokenized assets could reach 16 trillion US dollar by 2030. That's the equivalent of 10% of global GDP. So Jenny, you said you spent 30% of your time looking at disruptive technology, and tokenization, you mentioned, will be the most disruptive trend in asset management over the next decade, leading to all mutual funds, ETFs, I don't know whether I'm misquoting you, being on the blockchain eventually. So what is Templeton doing in terms of positioning yourself and the insights you gain from the various really frontier pilots that you've been doing in Europe and also in Hong Kong when HKMA's Assemble box?
I believe I said AI and blockchain will be the 2 most disruptive technologies. Look, we started getting involved in blockchain, just starting to build things within the network around, 2017, 2018. And then we had an approved tokenized money market fund in the US in 2020. I believe we're the only one running the actual money market fund, shareholder record, and transactions on the public blockchain. The other ones are shadowing the transactions on the public blockchain. And I'll tell you why that's an important distinction in a second. And then we started almost falling into it, but being what's called a node validator, where we validate transactions as part of the public blockchain on, I think, 13 different layer 1 or layer 2 platforms. And what we realized when we did that is if you're going to be in this space, you have to actually participate in the network to be able to have the information to kind of make some of the decisions around there. So why am I excited, and why do I say that I think it disrupts ultimately mutual funds and ETFs? I have to tell you, Franklin Templeton ran 4 shareholder record-keeping systems globally up until recently when we outsourced it to, I think, this guy. Nobody ever asked what programming language any one of those systems were in until it was written in blockchain. And the most important thing is just remember, this is just a really efficient technology, and each different chain optimizes for different things. But we were astonished when we got the money market fund approved and we parallel processed between our old system and the new blockchain system with how inexpensive it was versus the old system. And so that one, from a cost standpoint, I think is really important. The second thing that's going to be important, this is why the distinction of managing the tokens truly on the public chain in a wallet is because if, for example, today we work in Project Ensemble with HKMA on a tokenized kind of stable coin, but ours will be a yield coin. If people are trading on the weekend and your transactions are part of a money market fund and they're just shadowed, they can't transact until Monday, right? And so if I need to transfer my token to Mike for collateral, it can't really happen truly until Monday. But if it's an actual tokenized unit, the settlement, everything goes with that. And then because it's a smart contract, you can have the NAV that's calculated immediately. You can have the KYC done as part of the token. All the things that we do can ultimately, now some of this is a bit out there, but ultimately can be embedded in that token, which is going to drive out a bunch of costs and friction in transactions, which is going to open up new types of investment opportunities. So that's why we're excited about it.
But you will need scale. You need, if you want transfer across different banks, you will need an interoperable blockchain. So what are you doing? Do you see that scale?
Need scale in what way? What do you mean by?
Well, if you are selling all your prediction, all your ETF and mutual funds will be on
right.
blockchain.
So exactly. So we just got UCITS approval. You really need to have global regulatory approval. Our view is all of this gets regulated, right? It all gets regulated, and it's difficult because, as you know, nobody knows better than you how challenging it can be because of things like atomic settlement and others. Exactly how you define regulation in an environment that is changing so quickly. You know, if the value of a token in Fortnite can be sold between 2 people, should that be regulated in a online gaming? So it's complicated to do. But what we found is that you really need to be able to transfer these tokens across a global regulatory environment. And so yes, from a scale, from that standpoint, absolutely.
Yes. Peng, you're a chair of EDX, which is a platform for trading crypto. So where do you see that platform going? I mean, now that Trump 2.0, so will we see more of activities there or regulation there?
Yeah, so, you know, it started a little over 2 years ago in many of our conversations with our partners and clients and counterparties, where there was an emerging desire among our US-based partners to look for a more grown-up way of transacting in crypto, right? So the issues ranged from people were uncomfortable with the lack of separation between exchange dealer and custodian solutions. People wanted a more familiar setup for exchanges with co-location, standard protocols. People were looking for central clearing solutions and so on and so forth. So, you know, we got together with our partners at Fidelity, Charles Schwab, Sequoia, and Virtu Financial, and started putting together a bit of a consortium and started a crypto exchange that's supported and underpinned by what you call traditional financial institutions based in the United States. I think the plan initially had a heavy institutional focus. Then the regulations over the last 2 years, instead of providing additional clarity, in fact, muddied what is okay and not okay in cryptocurrency for US-based institutions quite a bit, right? So by and large, SEC-led a enforcement-based approach for crypto regulation, which made it more and more confusing. Now, but over those 2 years, instead, EDX have really focused on connecting to and trading with US-based retail platforms instead. So on the basis of that, EDX has grown a lot. Q3, in fact, grew by another 60%. That's a combination of increased adoption from the various different retail platforms, as well as increased interest and transaction volume in cryptocurrencies in the United States itself. Post the most recent election, I think the industry consensus view is that we'll likely find more collaborative regulatory approach for the transaction of cryptocurrencies in the United States. And in fact, we're already getting some incomings from financial institutions that essentially went away over the last 2 years to start re-engaging in exploring how they themselves or they can enable the best way they can enable their clients to invest and participate in trading of cryptocurrency as well. So we continue to invest in that, support that, and it does look like we're at this pivot point where US institutions are taking another serious look at the investing and trading in cryptocurrencies.
Daniel, it seems that the banks are taking a slower pace, maybe because of regulatory constraints, but you do have a successful platform for trading intrabank Ripple.
Yes, if you could have asked me several years ago how much this will progress, I would have thought that a lot more than it did. And I think that one of the reasons why it didn't, is all the problems that happen with unregulated crypto changes, cryptocurrencies that came and go, created a very defensive approach from regulators. So therefore, the banks, at least in the US, we haven't been allowed to participate in public networks. We're only allowed in private networks. That makes the use cases a lot more limited. Yeah, we have experimented a lot in like intraday repos. We have a network of banks and the Monetary Authority of Singapore to process payments 24/7. We have done monetization and provide liquidity on tokenized money markets fund, but still very, very little. I think that this technology is so powerful that once it gets delinked to the good and bad of cryptocurrencies, it will probably evolve very, very fast. And I see, for example, in cross-border payments, a massive use case. In tokenized securities, a massive use case. So I think that this will accelerate over time, but at the moment it's been not as powerful as we would have hoped several years ago.
Mike, this time you have the last word. Remember last year you did not. So are we overestimating the change, or are we too excited about AI and digitalization in the next 2 years and actually underestimating that change that we'll make in 10 years' time?
Yeah, if you look at Netflix, it took 10 years to have 100 million users. It took OpenAI 2 months to have 100 million users. And now it has 200 million users. So we're in the noisy phase of implementation where there's just pride in the volume of activity in many people and less efficacy, but more pride. I think as you go through the cycle, it's going to be massively impactful to our world, AI in general. I think it will change jobs, it will eliminate jobs, it will create jobs, but it will be a huge impact for sure.
So thank you. Let's put our hands together for our distinguished panelists.